Good evening, everyone. Welcome to Brickwork Ratings webinar on untangling the threads of the Cottonyan industry. In this session, we will be taking you through BWR's insights on the sector and also get views of eminent market experts. Let me introduce our esteemed panelists for today's webinar. First up, Mr. Ashish Bhagavia. Mr. Ashish Bhagavia, a qualified mechanical engineer, is the chairman and managing director of Winsome Textile Industries Limited, a BSE listed entity. He has been the past chairman of Northern India Textile Mills Association and past member of the Textile Committee of Government of India. He is an executive committee member of Confederation of Indian Textile Industry, a special invitee on the executive committee of PhD Chamber of Commerce and Industry. Welcome, Ashish. Dhruv Satia. Mr. Dhruv Satia is the managing director of TC Spinners Private Limited. He has a rich experience of 15 plus years as a businessman and industrialist. Due to his expertise in selection of textile machinery, modernization and automation of the company's various facilities were undertaken under his leadership. Welcome, Dhruv.
Thank you.
Tanu Sharma. Ms. Tanu Sharma is a director at Brickwork Ratings and handles large corporates in North India. She is a chartered accountant by profession. Sudeep Sanwal. Mr. Sudeep Sanwal is an associate director at Brickwork Ratings and has extensively looked at the textile sector, including being the sectoral co-head in one of his previous organizations. In the next 10 to 12 minutes, Sudeep will take us through the presentation on the sector. Over to you, Sudeep.
Yeah, thanks, Chintan. If you can please show the presentation. Yeah, thank you. Thanks, Chintan, and a very good evening to and a very warm welcome to all our participants for this webinar. Next slide, please, Ria. So in this presentation, we shall be talking about the cotton yarn production and export outlook for FY23, factors which have helped the Indian cotton spinners to grow in the recent past, major challenges confronting the cotton spinners today, and finally, we'll be talking about Brickwork's view on the financial performance of the industry players going forward. Yeah, next slide. So after being hit by the COVID-19 pandemic first wave in 2020, exports came to the rescue of the Indian spinners. Recovery in demand started from Q2 FY21 onwards, with the full year FY21 showing an export growth of more than 5%, despite a significant dip of 22% in the first quarter itself. We would like to stress upon the fact here that even though exports increased by 5.5% in FY21, cotton yarn production declined by 19% year on year, implying that domestic demand lagged significantly in comparison to the pre-COVID levels. Healthy export demand came to the rescue of the domestic spinners in Q1 FY22 also, when India went into semi-lockdown stage during the second wave of COVID-19 pandemic. In the 10-month FY22 period, exports grew at a healthy rate of 44%, which has been the major reason for nearly 32% year-on-year increase in the overall production witnessed by the industry during this period. So Brickwork Ratings expects that based on the surge in export orders and revival in domestic downstream demand, Indian cotton yarn production should show a more than 25% increase in FY22, with exports projected to grow by over 40% on a year-on-year basis in the previous financial year. However, the year-on-year production growth is expected to moderate in financial year 23 to nearly 5%, which will be mainly on account of the high base effect. Increased domestic downstream demand is expected to be the major growth driver in financial year 23, with schools, offices, and economy in general opening up. Domestic demand is yet to reach the pre-COVID levels, but FY23 is expected to be the year when this is supposed to happen, provided the COVID pandemic remains in check. Next slide, please. So demand growth in the last 7 to 8 quarters has been on the back of various factors, some of which we'll be talking about now. In January 2021, the US imposed a blanket ban on products containing cotton originating from the Xinjiang area of China, citing forced labor issues in the region. Cotton produced in the Xinjiang area constituted around 85% of the total cotton produced in China and nearly 20% of the world cotton production. Therefore, the ban imposed by the US led to demand for both cotton and cotton yarn shifting to other destinations, including India. Many fabric and garment manufacturers within and outside China who fulfilled their, yeah, previous slide only. Yeah, thanks. So many fabric and garment manufacturers within and outside China who fulfilled their cotton yarn requirements from the Xinjiang cotton were forced to shift their supplier base from Xinjiang to other destinations. Indian cotton spinners have benefited immensely from the ban as it is getting reflected from the increased exports originating from India post the move. Yeah, next slide. So, post the COVID-19 pandemic, in order to reduce their dependence on China and broaden their supply chains, many retailers and aggregators around the globe have started looking at other sourcing options apart from China, which has resulted in market share moving to other geographies, including India. This trend is also being witnessed in the Indian home textile sector, where India is the second largest exporter of home textile in the world after China. The US and Europe are the two major markets for the home textile segment, accounting for more than 50% of the total imports in the world. In the US, where India has the largest market share in most product categories, its share has further increased in calendar year 20 and calendar year 21, as is getting depicted in the graph in front of us. This increase has come on the back of China losing its market share to other players. Orders which were earlier being serviced by China are now being routed to India, Bangladesh, Pakistan, and Vietnam. China plus one is being adopted by most global aggregators and retailers, resulting in this shift of demand. This has been further helped by the depreciation of Indian rupee against the US dollar, making Indian products attractive in the global markets. So at the same time, the demand in the domestic home type segment has also increased owing to increased consumer focus on home decor due to the work from home scenario. So collectively, this has resulted in improved capacity utilization levels for the Indian home textile mills, resulting in higher demand for cotton yarn for domestic consumption. China plus one policy has also helped Bangladesh ready-made garment industry immensely, as orders that were earlier being serviced by the Chinese garment players are now being routed to other geographies, including Bangladesh. So this has also resulted in increased demand for Indian cotton yarn from Bangladesh. Bangladesh has now surpassed China to become the biggest destination for cotton yarn exports originating from India, with its share increasing from less than 20% in FY2019 to 40% in 10-month FY22. Next slide, please. So in the last few quarters, we have seen Government of India doing its part to ensure that the demand cycle keeps moving. An outlay of more than 4,400 crore has been announced by the government to create 7 textile parks in the next 5 years, which will help increase investment and production levels in the industry. At the same time, inclusion of cotton yarn exports under the RODTEP scheme, or remission of duties and taxes on exported products, from January 2021 onwards, has also made Indian cotton yarn competitive in the export market. In addition to that, the recent trade agreements signed between India, UAE, and India, Australia are also expected to boost apparel exports from the country, which will further lend support to the cotton yarn consumption in the domestic market. Next slide, please. So today, the major challenge confronting the Indian cotton spinners is the high cotton fiber prices. Interestingly enough, the scenario was entirely different a couple of months back. Low cotton prices in the domestic market was something which used to give Indian spinners a competitive advantage in the global markets. If you look at the graph on the left-hand side of our screens, we will observe that international cotton prices increased by nearly 3.5% month on month on an average during the 16-month period from October 2020 to January 2022. During the same period, the average international cotton prices remained 7 to 8% higher than the average local or Indian cotton prices. How the gap between the domestic and international cotton prices has narrowed down in the last few months, with domestic prices leveling up with the international cotton prices in the later part of March 2022. Major reasons, apart from the increased demand in the local market, have been the slow arrival of cotton in the mandis, with the farmers holding on to inventory in anticipation of better prices, and revised estimates given by the Cotton Association of India on the cotton crop during the current cotton season. So, as per the revised estimates, the cotton crop is expected to be close to 335 lakh bales compared to 353 lakh bales in the previous cotton season 2020-2021, which is a year-on-year decline of nearly 5%. This increase in the domestic cotton prices even resulted in intervention from the Government of India, which has exempted all custom duties on the import of cotton till September 30th, 2022. This announcement was made in the second week of April. However, despite that, it is being observed that many spinning mills across India have been cutting their production levels since they are not able to recover the increased raw material costs from their customers. Brickwork Ratings estimates that spinning companies may have to shed a part of their profitability in order to stay competitive in the short term. Having said that, many spinning mills across India had been accumulating cotton in excess to their normal holding periods, which is expected to help them tide over this impact of present high raw material price situation in the short run. Next slide, please. Now we shall be talking about the financial performance of the Indian spinners in the recent past and what the near future holds for them. Brickwork Ratings has taken a sample of mid and large entities in the segment that derive majority of their income from cotton yarn. The operating income of the sample entities declined by nearly 3% year on year in financial year 21 because of the hit they received from the COVID-19 pandemic first wave in the first quarter. However, the profitability margin showed a considerable improvement on a year-on-year basis, increasing to more than 15% in financial year 21 compared to 13% in the previous year. This was mainly on the back of better demand after the first quarter, resulting in high capacity utilization levels, thereby leading to better optimization of fixed cost, healthy spreads of healthy contribution, that is the difference between the yarn realization and cotton prices, and various cost saving measures implemented by the companies at that point in time. Access to low cost cotton from the previous season also supported the contribution margins of the companies operating in the segment. These factors continue to support the operational and financial performance of these companies in financial year 22 also, with the income of the sample companies increasing by a healthy 65% in 9-month FY22 period over the same period compared to the same period last year. The profitability margins stood at an all-time high level for some of these entities, with the 9-month FY22 average EBITDA margins at around 27%. Furthermore, with limited capex incurred by the companies in the last few years and reduced reliance on the outside working capital limits, owing to healthy cash accrual generation, the interest coverage ratio, which is one of the major debt coverage indicators looked at, touched 24 times in Q3 FY22. Brickwork expects income of the sample companies to increase by a modest 10% in FY23. This will be on the high base of financial year 22. High domestic downstream industry demand rather than exports is expected to be the major growth driver in financial year 23, where the demand is yet to reach the pre-COVID levels. However, high raw material prices are likely to play a deterrent going forward and lead to diminished spreads and consequently a moderation in the profitability margins from the present levels. The beta margins for the sample companies is expected to mellow down to around 16 to 18% compared to 25% projected for financial year 22. Reckoning increased demand and comfortable debt coverage indicators, many companies have announced their capacity expansion plans for the near term. However, the leverage ratios for the companies undertaking capex are not expected to deteriorate much, owing to low reliance on outside debt, with a major requirement expected to be met from the internal accruals. Yeah, next slide. So this brings us to the end of our presentation. Over to you, Chintan. Thank you.
Thanks, Sudeep, for the insights on the sector. We start with a couple of questions to our panelists. In the meanwhile, requesting all the participants to post their questions for the panelists in the comments box. My first question is to Ashish. How do you see the export demand shaping up? The ban on Xinjiang cotton by the US has provided an opportunity for India to increase the market share. Do you see the positive impact of this trend continuing in the medium term?
Yeah, Chintan, as we saw in Sudeep's slides, we see the share of the Indian made-ups, Indian fabrics, cotton fabrics going up in the US markets. Uh, Presently, we are we don't have enough capacities worldwide to completely replace China. So this shift is going to continue. It may take at least anything between 3 to 5 years before it actually happens. Uh, we can also see that overall cotton yarn consumption has also slightly gone down in China. That is also one of the uh, impact of this Xinjiang cotton. Other than the US market, even some of the European brands, especially those who have international exposure, which means they also have stores in the US, even they have given an advisory that they will not be using Xinjiang cotton. So all these factors are playing out at the moment. It's not going to happen overnight. We don't have capacities across the value chain to make that happen instantly. So I'm quite sure that this trend is going to continue for a few years, which is going to be great for the Indian cotton value chain, not only for spinning, but made ups, fabrics, across the value chain, garments. Another thing that is going to further increase the competitiveness of India is also going to be the other FTAs, other than what we have already signed. So we just read in newspapers today that the Prime Minister had a meeting yesterday with the Commissioner from EU. So that's on the cards, that's on fast track. India Canada FTA is on a fast track. So all these FTAs is further going to help the Indian textile industry. Thank you.
Thanks, Ashish, for those inputs. My next question is to Dhruv. Dhruv, what is your outlook on the cotton yarn sector? Will rising exports and domestic recovery continue to sustain the momentum?
Yeah, Chintan, I am very optimistic on the outlook of the Cottonyan sector. As rightly covered in your presentation also and mentioned by Ashish ji also, the FTAs which are going on, and you mentioned we have tied up with UAE, we have tied up with Australia, and Honorable UK Prime Minister was here recently. He announced that before Diwali, even UK will be on line with India. So these all factors are going to benefit, definitely going to benefit the Indian textile industry. Yeah, but we need to catch up. Like the garmenting, spinning industry in India is already boosted. Like they are in good capacity. We have good capacities. We have good infrastructure. But yes, we are lacking in garmenting sector. If we catch up on the garment side, and I think this will be very good for in the long run for the whole cotton textile chain. And uh, I think almost all of the factors, Indian spinning industry, cotton spinning industry, is always dependent on exports because of surplus capacity we have. So all the factors with the ban on the Chinese cotton and this coming cotton season, we are expecting around 25% increase in acreage. And if on top of it we can increase the uh, yield per hectare, that is going to be another shot in the arm. Government is working on it. Let's see how it turns up. 25% is expected, the acreage is expected because this was the first time, last year was the last cotton season, was the first time that actually farmers got the money. They sold their crop at their whatever price they wanted. Earlier, it was not the same. Earlier, middlemen or your the companies or the mills who used to keep the stock, they were the one who gained. But this was the first time farmer gained. So we are expecting a bumper crop, and obviously this will be good for the whole textile chain. Rest export, like we are in touch with our buyers in Bangladesh or other countries. What they give us, they tell us is that we have sufficient order book. Retailers have curtailed their orders only because of the price. So maybe Q1 23 would be not that good, and I expect it to be moderate and then good in the coming time. All the factors like INR, the cotton prices when once we get the new crop. I don't know. See, that cannot be estimated right now, but that the crop size indicates that will be in good position. And I think all the factors are favorable for Indian industry. Yeah, quarter Q1 would be a little problematic, and hopefully things will recover after that.
Thanks, Dhruv. So basically, the opportunities are clearly there, especially on the export side. But now I'd like to come to Tanu. Tanu, what are the current challenges that are facing the sector?
Sure, Chintan. So the challenges from a credit perspective and even from the management of operations perspective has always been in the textile business is to manage the inventory price risk, because this is clearly one area where there is a fair bit of uncertainty. While things have been stable in between, as we see right now, we are again in a position where raw material prices have suddenly become very, very volatile. So I think there is again a step to take back and recalibrate the stock holding policy, because we had a unprecedented kind of a price crash situation quite some time, a decade back, wherein textile companies and the spinning companies try to reduce their cotton stocking for to less than like 6 months. Earlier they used to usually stock more for 6 months, and then it may became more of a speculation as to whether we should stock up for 6 months or 3 months. Every company had their own policies, and which have their own pros and cons. But yeah, this again, we have come up to a situation where sudden price movements in the raw material pricing have left everybody a little worried if they have not stocked up on the low cost cotton, because that is something which helps you sail through the periods of scarcity, especially. So there has been a scarcity of cotton, like in the current scenario. Yes, this quarter there will be a challenge for the spinners to maintain profitability. If we were to look at the spot basis, I think there are EBITDA losses. In fact, if one was to buy cotton right now and try to sell. So there will be always that angle, and this also leads to another thread, which is the substitution, because there is a lot of blending of polyester and other synthetic fibers now into the cotton, into the product value chain. So this blending is only going to increase. As we know, India is actually lacking behind in terms of synthetic blending and synthetic fiber usage. It is actually reverse of the other developed markets, where synthetic usage is actually two-thirds of their overall fiber consumption. India is still at one-third and slightly trying to increase with the government policy support. I think this is only going to go up, and this is one way where we can manage or handle the cotton price volatility to some extent, because of synthetic price raw materials being I think the supply chain is more predictable. However, there is another rub-off effect of the high crude prices also on the synthetic raw material prices. So I think there is a substitution. It's pretty much evolving, and it will be good for companies to diversify a little bit into the other raw materials as well. So I think raw material, because that is the major component of the cost also for spinners, it always has been a very important factor to manage. Apart from other factors, which other challenges would be managing the environmental risk, managing the compliance and the governance. Just like we know the Chinese cotton issue is more of a labor or human rights issue. So we have to start looking at the ESG part also, which will be the future, or everybody has to be sustainable in the business model, because cotton being a natural fiber, it has a linkage in the complete textile value chain, and it is very important that companies also comply with the pollution norms and the other norms, which kind of needs to be taken care. So those are the challenges. Apart from that, financial challenges which we see is to manage your debt cycles and debt repayments. We see that all these yarn companies are coming up with large capex plans. Now this is well calibrated because we are already at a fair bit of high capacity utilization. The sector was at a very high capacity utilization despite COVID and everything. So companies have already started investing into more capacities, which is, I think, pertinent. And as we see and as we have analyzed, this capex is not going to be detrimental on the credit profiles. One is because of the accumulated cash profits of the last 1.5 years, which have been very healthy. So 22 particularly has been very healthy. 23 is expected to taper off, but then it is going to still stay healthy and higher than the pre-pandemic levels. So with this cash accumulation, I think debt repayment is one area where companies are focusing on. They are able to manage. I mean, COVID has taught everybody to manage their working capital more effectively. So that is something which is going to continue. And yes, I mean, the profitability for spinners also will remain healthy, barring this little bit turmoil because of the sudden cotton price increase. So whoever has not really stocked up cotton, yes, the next 6 months seem to be a little difficult. But then it is always a cost plus industry, and the yarn prices will eventually reflect the raw material prices. So yes, I think the future seems to be bright, and the challenges are manageable if companies are putting some thought behind it. I think the capex cycle is not going to be detrimental, and unless they're not able to really manage the underlying issues as I just suggested. So that's my view, Chintan, and over to you.
So yeah, that's something positive and good to hear on that. Just coming on to the current geopolitical concerns, Sudeep, what are your views on the impact of, say, the Russia-Ukraine conflict and the Sri Lankan economic crisis on the cotton yarn or the textile sector as a whole?
Yeah, see, Chintan, the Sri Lankan crisis has had a positive rub-off only on the Indian garmenting units. So if we go by the numbers, the Sri Lankan textile and export constitutes around 50% of the total exports which are originating from the nation. Another major item being exported from China is tea, in which we have already seen orders moving from Sri Lanka to India. Similar thing is happening in textile and apparel also. We all know that how production of various items is in Sri Lanka has been affected due to power cuts, regular power cuts, fuel shortage, and people suffering from high prices of essential commodities. The demand from various large international brands, which were earlier being catered to by Sri Lanka, is now being moved to India and other geographies, including Bangladesh and Vietnam. So Indian players have everything to gain from that turmoil. The story is entirely different in the Russian and Ukraine crisis. So, if we talk about the share of Indian textile players in the import basket of Russia, the amount is quite small. Talking about the Asian countries specifically, Russia imports close to 650 to 700 USD million worth of textile and apparel products every month from Asia, where China is having the maximum share of around 60%. Bangladesh comes at number two with nearly 15% share of this 650 to 700 monthly figure, while Indian textile and apparel exports close to Russia constitute only around 18 to 20 USD million every month. Though this quantum of direct export to Russia is quite small, players which are having significant concentration towards Russia have surely been affected by this war. Also, there are large aggregators in Europe, especially in the ready-made garment segment, which buy textile goods from India and then sell them in Russia and Ukraine. So, orders from these European buyers have also seen a steady decline after this war has started. So, there are select pockets in Indian textile and apparel markets like Tirupur and Panipat, which have been which have high indirect concentration towards Russia via this European Union, and where the impact felt is quite severe. Another concern is the rising cost of food and essential raw materials, which in turn stokes up the inflation and raises the input costs. So it has become difficult for manufacturers to deliver orders at the prices which were decided at the time of taking the orders. On the freight side, also impact has been felt. The war has impacted cargo movements across different trade routes. Closing of the Russia-Ukraine airspace has led to lengthy transit times on some of the major routes, which has led to constraining of the capacity further. In addition to this, what we have seen is that there are labor issues at some of the airports in Europe, which is leading to disruption in warehouse activities and further delays in the transit times. Some of the rail links have also been impacted, which is again leading to container shortage and increased transit time and costs. Also, this war has had a direct impact on the inflation across the economies, and high inflation leads to less spending on discretionary items. And we all know that a large part of textile and apparel comes under discretionary item. So all in all, the impact is being felt, and the pain might continue to grow if this war continues. So these are my two cents. Thanks, Chintan.
Done, Sudeep. So now we'll be taking up the questions from the participants. We'll wait for about 10 to 15 seconds for the questions to be lined up. Yes, sir. The first question from the participants are to Ashish. What are suggestions to the government on the steps to be taken to further support the sector?
So Chintan, as Tanu pointed out, that obviously cotton price of cotton plays a very, very important role in the profitability for in not only the spinning industry but for the entire cotton textile value chain. So two important things that we really need to work on the cotton side. One is a stable policy on imports. Now, India always had, not always, I would say, for the last 10 years at least, we had a zero import duty on import of cotton. Cotton that is imported in India are normally in two scenarios. One, we regularly import the ELS cotton, which is basically the Gizas and the Supremas, which we don't grow in India. And secondly, we were importing the normal cotton, which is normal cotton, I mean normal staple lengths, which is contamination free, like the Australian or the Brazilian or even the American cotton. Now, all these cottons in both scenarios, they're not really available in India. And in fact, by imposing an import duty, some of the spinners who are using these kind of cottons have become uncompetitive. So one, we need a very stable policy, and not only that government should remove import duty till September that they have announced, but it should be removed forever. The government is scared that the farmer is getting hurt if they have a zero import duty. But if we see historically, India only imports the normal cottons which we grow in India and which can hurt the farmer is only when prices internationally move up very high. And whenever that scenario happens, the Indian farmer already has got a much higher price than the MSP that was there in the country. So very rarely do we see a scenario, or I don't foresee a scenario where we see the farmer getting hurt because of an import duty on cotton. So this is one policy that the government needs to be very clear about and inform the industry, and we need a very stable policy on that. The second area, as far as cotton is concerned, is increasing the yields. We saw a huge jump in yields in India when we introduced the BT cotton. If I remember correctly, it increased by almost 100% over a period of time from where we were. And once we introduced BT cotton was at a point was almost 95% of the total cotton grown in India. But over the years, we have seen a steady decline in cotton yields. We used to have a technology mission on cotton, which was funded by the government of India, and that worked on various areas to increase cotton yields. That mission is over. there is not much of support from the government on that side. So that is another area that our industry has been giving and talking to the government for providing support. I would say these are the two main areas as far as the raw material part is concerned. As far as yarn is concerned, the government did a great thing by announcing the RODTEP scheme, not only for cotton yarn but for all products, other than few areas like pharma and engineering. And obviously, the RODTEP scheme has made the Indian textile industry very competitive. So I hope this remission of duties continues and it's a stable policy rather than government tinkering with the duty rates on and off. That's it. Thank you.
Thanks, Ashish. Our next question, probably Dhruv can take this up. What is your view on the profitability of players in FY23? Will rising cotton prices pose a major threat to the financials of the players?
Yeah, Chetan, see, according to me, definitely the cotton opening price of the new cotton will not be what it used to be earlier. So definitely there will be, see, FY22 was an exceptional case in any case. It was an exceptional year. So you cannot expect FY22 to repeat again. But yes, I feel after FY, like second quarter, third and fourth quarter would be good enough, and hopefully something between 12 to 15% should be the average out we do. But again, there are many riders, COVID situation in the country, international situations. Many players have shifted to PC and other blends in order to avoid buying the shortage of cotton. Many players have shifted to spun yarn. So, see, that will again determine how people are switching, what action, that will be case to case basis. But yes, for cotton yarn, majorly cotton yarn players, I expect see 12 to 15% of beta, and I think that should be achievable because all other factors we feel are in favor of the industry right now, and especially the bumper crop which we are expecting.
So, though it would be fair to say that the margins, though might dip from say FY22 levels, it would still be closer, better than the FY21 levels. I think that's can
Yeah,
be what we
definitely,
can conclude also, right?
definitely will be better than FY21. Yeah.
Sure.
See, right, then riders are again there. Even as I mentioned
Yes,
earlier,
yes, yes.
the COVID situation and all these are dependent. But it is like if you see the past trend, whenever we have a good crop, the industry is in good financial health. Whenever whichever year we have got a good crop size, the industry has performed well.
Done. Thanks, Dhruv. I think next question is more a credit related, credit rating related. So probably Tanu can come in here. In general, what are the topmost challenges and solutions for the sector in terms of external credit rating agency?
Yeah. So, any credit rating, when we do, especially if we do it for the textile sector, there are certain factors that we have to analyze. So, like in any textile company, we will look at one is the business profile and one is the financial profile of the company, and then the other generic factors like the industry, the positioning, and everything. So what I feel is the major challenge that comes when we rate textile companies, especially the yarn companies and particularly the cotton yarn companies, it is one is the scalability of operations. One is really the scale of operations itself, and the value addition. Because so far, as I see and as everybody has seen, cotton yarn is more of a commodity or a semi-commodity sector, unless we are really going into value added yarns and the higher counts of cotton, wherein the profitability is more resilient because of one is the end users segments are niche and they are more value deriving. So the important is the product mix is very important when we rate a cotton yarn or any textile company. and that the predictability of their profitability and revenues is very crucial. And in as we discuss or we see now, the scarcity of raw material can build up at any stage, when the prices can start going in any direction, and there are a lot of macro factors beyond the control of the company. The seasonality of the raw material is also one important aspect. So when we analyze the business profile, we have to really see as to what has been the track record that comes into play. As in, have they really, the company really managed their working capital cycle very well? Have they really managed the I would say the inventory price risk very well? Has there any volatility reflected in their profitability in the last 5 or 10 years? If we can see that, we can take a call as to whether this company will be able to achieve whatever it is projecting. And these things become very important when a company is in the midst of a capex program, because we have to really see that is the company able to derive the optimum utilizations from the projected capex. So that is, I'm coming on to the financial risk profile now. So textile sector, as we see it, it's more of a debt intensive sector, because there are both term loans for the capex and expansions that the companies do, and there's a lot of working capital intensive operations. As such, cotton being a seasonal product, they have to, companies have to stock up cotton, and that involves a lot of working capital requirement at the company's ends. Also, the export market also involves a lot of receivables, which is again where the working capital will get stuck. So to really manage this is very important. We have seen a lot of state support in terms of subsidizing of capex related debt, with a lot of subsidies under the TAFs program, and even the states have supported by additional schemes which really bring down the cost of debt. And because of this, sector has taken a lot of debt, because of which it becomes a little vulnerable in the times of EBITDA shocks. So in case really there is a sudden fall in EBITDA, it can really shoot up the leverage for the company. So coming to financial risk profile, I think leverage, the coverage, the debt service coverage, and the cash accruals to debt. These ratios really become important for any company in general, and particularly a cotton textile company, because they have a high size of debt. It is important that the profitability remains under control, and which is sometimes beyond the control of the company. Solutions are that we have to really rely on the track record of the company is one, and obviously the direction from where the industry is moving, then the peers within which how the company is operating. But yes, I've seen that in the sector the ratings tend to be sometimes a little more volatile. That is, we can see upgrades and then downgrades also. So I would always suggest that in textile sector, how rating agencies look at it, as they want to really see a established track record before really upgrading a rating, so that we know that the rating will not suddenly through the cycle, the ratings should actually hold good. So yeah, those are the, I think, challenges and the solutions. The important point is that at any point whenever we are rating, we have to really very strongly look at how the industry is going to perform. The outlook becomes very important in a cotton yarn
Thanks,
business.
thanks, Tanu, for summarizing those credit points, and especially the through the cycle ratings that we always talk about. So thanks for those inputs. Next question is to Ashish. How strong will the export demand be going forward? Will the FTA India signing help the sector on an overall basis?
Uh, I'll break it up into two parts. So the first part, obviously, as we've all been discussing, that there's a huge increase in raw material costs, leading to a huge increase in cotton yarn prices. So in the short term, I would say that there is going to, in the near short term, I would say next 2-3 months, I expect that there will be some demand destruction, and some products may be forced to shift to blended yarns because of the really high price of cotton yarns that is being quoted by the manufacturers now. But in the long term, obviously, we are seeing an increase in exports of cotton yarn, and that is going to be helpful to maintain the profitability in the medium to short term. As Dhruv also pointed out, that there will be some pain that the industry will feel in the next few months. But thereafter, again, we are expecting a huge crop starting October, generally October. But again, we are expecting, because of early sowing of cotton, we are expecting the North India crop to start moving in early September itself. So again, with all these factors, we expect that the Indian cotton prices will once again come below the New York futures. And once that scenario comes in, we again expect exports to grow and continue to grow in the future.
Thanks, Ashish. Our next question is for Dhruv. On the pricing differential, there's a question from the participants. We obviously know that the domestic cotton and the international pricing gap has reduced in the recent months. Do you think that this gap is expected to further reduce, or it will remain at the same levels, say in the next 3 to 6 months?
Sorry, your question is not clear. Can you repeat it?
What I'm saying is, the question is that on the pricing differentials between the international and the domestic cotton prices, it has narrowed down in the recent past. What the question is basically, in the next 3 to 6 months, is it expected to remain at the similar levels, or is it expected to further reduce or increase? What are your views on that?
See, what I gather is that the on-call position on New York cotton futures is on a tip, like they're going to settle it down. So once the May calls are completed, we expect the US future to go a little downward, and that will again pull down the a little bit Indian prices also. So the your question about the gap, gap would be again. See, we always in the New York future prices have since like they have linked with the MCX, and kind of domestic prices also are linked indirectly. Nowadays, what we see is even cotton farmers look at the futures, cotton futures in the morning, then they bring their trolley. That is it. If it is up, they prefer selling. If it is down, they avoid. So the gap or the difference between the Indian cotton and New York international cotton futures would somehow be linked only. I believe it will be a linked only. It will remain in a staggered cycle, a kind of like it is interlinked only. It cannot be go haywire. It is cannot go in opposite directions. So somehow, yeah, the difference may increase or decrease a little bit, but it will be range bound. So some it will be linked with the international futures only. The trend, if you see, the trend would be similar, both the cotton, Indian cotton and New York cotton futures. The trend and the graphical data would be all approximately the same direction. Will go in the same direction.
Dhruv, just a follow-on question on the percentage contribution. So, what is the overall contribution of the textile sector to the GDP of India broadly? And is textile sector really dependent on exports, as we see this sector is majorly unorganized?
Yeah, see, I think the government data was around 5 to 6%, but yes, there are unorganized sector which are earlier, which was totally in on cash basis, and so if you count all those, maybe it is a little more. It will add up to that. Still, what in the rural areas, if we go, still there are people who are doing business on totally cash basis. Still there. So that is not accounted for ever. That is never accounted for. But that is only in case of rural areas, very rural areas.
Done. Thanks, Dhruv. Next question is to Sudeep. Sudeep, the experts have come to the rescue in the past, which is what we covered in the report and in the presentation as well. Do you think this is expected to remain so in the next say 1 or 2 years, or will the domestic markets start picking up and close the gap between the international and the domestic sales?
Yeah. See, what has happened in FY22 was that, the major increase in production was owing to high exports. So exports were expected to grow at around 40% in financial year 22 on a year-on-year basis, which is expected to lead to, around 25% increase in the cotton yarn production in the financial year 22. So going forward, talking about FY23 specifically, what we anticipate is that major growth driver will be the domestic downstream demand, where the consumption will be happening within India only. So what we have seen is that because of COVID, weaving was one segment which was lacking, and knitting was doing okay. But now with opening up of schools, colleges, and offices, the weaving segment is also expected to pick up. Apart from that, we have already seen there is demand in the home textile segment. So all in all, plus, there have been certain steps taken on the trade front also by the government, which is further expected to propel the export demand for ready-made garments and made-ups. So all in all these factors are expected to lead to increased domestic demand, and which is expected to be the major growth driver for the cotton production in the financial year 23. This is what we expect. Thanks.
Thanks, Sudeep. And next question, probably Tanu can take this up. Tanu, whether high debt intensity would reduce with higher profitability or cash profits during FY23? Basically, would this deleverage the sector?
So the cash profits which are high generated in 22, yes. So 22 point in time leverage will definitely look better, and it's actually because these are unprecedented margins also. So the leverage is also going to look like the lowest probably in maybe a decade or so. But I wouldn't believe that this will completely deleverage, because we already know that the capex cycle is coming in. What we see is, yes, the margins are stabilizing, and so is the interest coverage and leverage also better than the pre-pandemic levels. So with the capex cycle, we saw that in 2000, between 8 to 2012, the debt intensity and the leverage was really very high, and we've seen companies failing because of sudden volatility. I don't see that repeating now, so I can see that structurally the leverage and the debt profile of the textile companies has improved. The textile companies have also grown in scale and size, so their internal cash generation itself is good enough to take care of its debt repayments. So that the capex is not going to be onerous. So in that sense, yes, the debt intensity has moderated or come down, but the working capital debt will also be high because of high cotton prices and high even synthetic fiber prices. Both the kind of prices continue to remain high, and we see them to be high in the near term. So that intensity would be there. It will not go away altogether, but I think the company's leverage and the balance sheets are better positioned now to handle any kind of sudden volatility, as well as the overall structurally high debt that is going to come up. So even there will be capex, there will be debt, so there will be a deleveraging over a period of time, and yes, the balance sheets are more strong as of now. I hope that answers.
Sure, Tanu, it does. So I think in the interest of time, we'll be taking up one last question. Probably Ashish can take this, and it's more like a summary question. I think in terms of what is the outlook for the sector for, say, the next 2 years or so.
I'm a very optimistic person on the industry. That's why I remain in the industry. So, as I've been saying, that we have to see the strength of India. India has only been losing out, if you really see, on the RMG sector. And RMG sector, and losing out to whom? Bangladesh, Cambodia, Vietnam. Now, Cambodia is a different story, because Cambodia everything is basically Chinese owned, and they bring it, they bring their own fabrics to Cambodia. They make the RMG, and it goes to the US, EU, all the consuming countries. But Vietnam and Bangladesh, we've been losing out because of the FTAs, because they are getting duty-free advantage on the import side in United States and the EU. So this is really where the government is now working. We hope that we will get, or Indian RMG manufacturers will get this duty advantage. In the EU, Canada, UK, US, I think we are still far away. But even if we get EU, Canada, and UK, that's going to be a great fillip to the Indian RMG sector. That itself will drive, the growth in the entire textile value chain. We are the only country other than China where we are from fiber to finished product. No other country has this kind of infrastructure and the raw materials. Every raw material that we need, all important raw materials that we need are manufactured within the country. We have all processes, we have everything. So I'm still very, very bullish on the entire cotton textile value chain, including the spinning industry. Cotton yarn, as you know, exports is only 30% of the total cotton yarn production in India. 70% is still consumed domestically, or it is consumed in products manufactured in India, whether for domestic consumption or for export. So it is not only export which is going to drive the entire value chain or the growth in the value chain, but we also need increase in the domestic the domestic consumption is increasing, and also the FTAs, as I mentioned. As far as the cotton yarn sector is concerned, I personally see that this cotton yarn spinning, we are in a very, very good position. The total addition of spindlage in the country cannot be more than 1 million spindles a year, because the capacity to manufacture spindles in India is only around 2.5 million, out of which approximately 1.2, 1.3 million also gets scrapped every year. So on an average, we have seen that not more than 1 million spindles get added. And if we are looking at that 1 million spindles, it is only 2 to 2.5% of the existing spindlage of the country. But if we see a huge growth in demand, I don't think the industry is capable of adding more than 2 to 2.5% increase in capacity. So the demand for the yarn is going to be much greater in times to come than what we are able to produce. So I personally feel that we are on a very, very strong footing on a long-term basis. That's it. Thank you.
Done. Thank you. So I think from the overall outlook, I would say that it's a positive for FY23 at least, and that's what we heard from the panelists also. And while 22, I mean, replicating 22 might be a little difficult, but it's expected to be better than FY21 for sure. So that's, I think, in a nutshell, the overall outlook for the cotton yarn industry as a whole. And that would be it from this webinar. We would like to thank everyone, especially the esteemed panelists, for your time. Have a great week ahead, everyone. Thank you.
Thank you.
Thank you.
Yeah, thanks a lot.
Nice.